If you're thinking about buying penny stocks or stocks that are at $1 per share, then this might be the best penny stock to invest in because we detected unusual trades worth more than $500,000 on Pacific Biosciences stock, ticker symbol PACB. And so in this video, we will analyze this unusual option activity to find out if these investors are bullish in buying Pacific Biosciences or bearish in selling, because as we all know, stock prices go up or down based on supply and demand. How many shares of stock are being bought versus how many are being sold. If there's more money investing by buying, the stock goes up. And if there's more money being cashed out by selling, the stock goes down. And so, without further ado, let's dive into the data analysis of these unusual trades. Now, as we can see here on the chart, the stock recently rallied after earnings, bouncing up from a support level near its 52-week low of $1.16. And so this could be a bullish signal on a technical analysis basis. But whenever the stock traded near this price level, it got rejected back down from this key resistance level. So this could be a potential risk or a bearish signal. And so technical analysis can get confusing, giving both sell and buy signals. And so to get a clear signal, let's analyze the real-time data of how investors are now trading this stock, data that makes a bigger impact on the stock's direction. As we can see here on the options time and sales tape, the most unusual trades we found happened at 10:04, 9:32, and 9:59 for these June 20 options at the two strike calls, being traded for a price of about 0.35, which is actually $35 each because we need to multiply by 100 since options are priced per share and each options contract represents 100 shares of stock. And so we can calculate the total cost of these trades by adding up the quantity of contracts. We have 7,973 plus 3,410 plus 2,000 plus 2,000 plus 1,500. And we get a total of 16,883 contracts. And then we multiply by the estimated cost of $35 each, and we get a total of $590,000, or about $500,000 on these trades. But keep in mind, this is a higher risk trade in comparison to the trades that we share on our website. And so if you want to get access to the lower risk and higher probability of profit trades, then go to our website. We'll put a link to our website at the top here where you can get access to better trade ideas that the wealthy investors and potential insiders are trading, because not all of these unusual trades will be profitable. Some will be a loss, but as long as we diversify our portfolio with higher quality stock picks based on stronger data analysis, then we can become more profitable in the long term. Now, even though this is higher risk, we still traded this, but we use position sizing to manage our risk. As you can see here on the options chain for the June 20 options at the two strike calls, since these were new opening trades, we also traded these call options and got into the same position here. POS stands for our position, and the green color means a buy position, while a red color would mean a sell position. Now, how did we know these were new opening trades? Well, notice that these two strike call options have an open interest of 1,378 contracts, which is much less than the volume of contracts being traded. In other words, it would not be possible to close out of that many contracts if there aren't even enough open contracts available. And so this data is very important to figure out, because if investors are closing their trade, it could indicate that it's time to step back rather than start a new trade. We always take this extra step to analyze the data at a deeper level because many other websites and scanners don't. they report all high volume unusual trades without filtering out closing trades, which leads to inaccurate results and losses for those following unusual option activity. And that is why we have more winning trades than other websites. We also analyze historical data. For example, we currently have 30,000 open contracts for the March 21 options at the $1.50 strike calls. And because we track this data all the time, we know these were relatively new trades being made just a few days ago, when the open interest was only 613 contracts. And so we emailed our members about this unusual trade already. If you want to get early access to these trade alerts, we'll put a link to our website at the top here where you can sign up to get better trade ideas based on the results of our data analysis. Now, with that said, based on our deep analysis of many variables in other data sets, which we do not have time to cover in this video, these investors bought these call options at $35 each, the same price as we calculated and saw earlier on the options time and sales tape. And so when we analyze this trade, you can see here on the risk profile profit loss graph where the x-axis represents the share price of the stock, which is currently trading over here, and the y-axis represents the amount of profit or loss. Note the zero break-even line here. And so when the purple line, which represents the current date, and the blue line, which represents the option's expiration date, are trading below this zero break-even line, this trade becomes more negative loss. And if it trades above it, this trade becomes more positive profitable because this is a long bullish trade. And we can confirm it here on the Greeks. We have a positive delta trade. If it was a short bearish trade, it would be a negative delta. But be aware of the risk of this trade. We have a negative theta decay, which means that as time goes on, this trade will lose in value. And that is why you can see here, the purple line drops down lower to the blue line as we approach the option's expiration date. Since these options lose value through time, the break even on this trade moves higher as time goes on. And so you can see here, even though these call options have a strike price of $2, the stock needs to trade above $2.35 per share for this trade to be profitable at expiration. And because of this risk, we only took a small position in this trade. We don't invest a lot of capital into these higher risk trades because we invest most of our capital into the lower risk, higher probability of profit trades that we share on our website. We'll put a link here where you can also learn about trading strategies to further reduce risk while increasing profits. Let us know in the comments below. Do you think Pacific Biosciences is a good penny stock to buy now? Or do you think it will crash back down? As usual, please hit the like button, subscribe if you haven't, take care, and have a wonderful day.